Good afternoon. Thank you very much for joining us. Welcome to Wildlands League's presentation on estate planning simplified. And this version, or this session, we have three of them. This one is Considerations Beyond the Will, How to Minimize Taxes. And we're very, very pleased today to have with us two experts in the field. Vlad Solokhine, he's a certified financial planner with over 15 years of experience in the financial services industry. He is currently a team member at the Lazar-Wealth Succession Strategies, a financial planning boutique in Markham, Ontario. Before starting his own financial planning practice in 2012, Vlad had the privilege to work in a major Canadian bank, an insurance company, and a mutual funds company in advisory and senior management roles. In his practice, Vlad specializes in philanthropy-focused financial planning, helping people with disabilities and people in career transition. He is the chairman of the board of High Notes Avante, the registered charity that inspires people touched by mental illness through artistic expression. Vlad is also a member of the Professional Advisor Committee of the Canadian Association of Gift Planners. Vlad lives in Markham and in his spare time enjoys family activities with his wife and 3 children. An interesting fact, Vlad has a bachelor's degree in physics. Another physics nerd. Thank you, Vlad. Candice Jay. Candice has over 15 years of experience in the financial industry and has her own practice under CCNL Private Capital. Prior to joining CCNL Private Capital, she was at Pembroke Private Wealth Management and HSBC Global Asset Management. Her practice guides and works with charitable foundations and high net worth clients, with a focus on women, entrepreneurs, and families to achieve their long-term financial goals. Strategic philanthropy is also an important part of Candice's practice, and she is passionate in working with clients to identify values and areas where philanthropy can play a role. She holds the Chartered Investment Manager designation, is a fellow of the Canadian Securities Institute, and was awarded the Master Financial Advisor of Philanthropy designation in 2020. Candice understands the importance of giving back to her community, and she is a current board member of the University of Toronto Alumni Association and UHN Impact Collective of the Toronto General and Western Hospital Foundation. She is also a member of the Canadian Association of Gift Planners, leading engagement and mentorship for professional advisors in the GTA chapter. In her spare time, Candice enjoys practicing yoga, playing golf and tennis, and taking hikes with her family and golden retriever, Sadie. Welcome to both of you, and thank you so much for offering this webinar for Wildlands League.
Thank you for having us, Janet.
So Jen, I think you can go to the next slide. Taking a minute just to go to the next slide. Sometimes these things happen right away, and sometimes there's a, oh, I'm sorry, we wanted to do it's my fault. We wanted to do the housekeeping rules. So Jen, I'm going to turn it over to you to do housekeeping rules, and then we'll come back to Vlad and Candice for their presentation. So Jennifer.
Thanks, Janet, and good afternoon, everyone. Thanks for joining us today. A few housekeeping rules. Your videos and speakers should be muted, and if you're listening via phone, please make sure your microphone is muted for reducing background noise. This will help us maintain a good bandwidth for the session. If you notice that the presenters' faces are covering any of the presentation information, you can adjust this in your personal settings. Just change the view in your control panel. If you have any questions, you can use the Q&A button at the bottom of your screen, and I'll be monitoring these questions during the session. We'll try to answer them during the session, but we'll get to them at the end if we don't. And please be sure to join us October 6th for our estate bypass and estate equalization session, and October 20th for wills and estate pitfalls. Sorry, that's a mouthful this morning. That's it for me. Back to you, Janet.
Okay, thanks so much. We're off to a roaring start, and so I'll turn it back to Candice and Vlad for your session on this webinar. Thank you very much.
All right, let's move on to the next slide here. And the title of this slide has Involuntary Philanthropy in it, which is in fact a taxation. In other words, we deal with this every day of every year. It was Benjamin Franklin who said that the death and taxes are the things that we could be certain about. What he did not say that the taxes immediately after death could be the worst thing humanity has ever been through. We deserve to distribute our money the way we want it. So we better take this involuntary philanthropy in our own hands before it's too late. This slide shows the actual distribution of the tax dollars in 2016-2017 tax year. And even though most of us agree that our tax dollars should fund the important causes, not everybody agrees with this specific distribution. Just think of it as a distribution of your estate. And immediately people might have their own figures associated with some fields such as children's benefits, elderly benefits, national defense, and so on. Somebody may even want to add environmental causes and nature preservation. Surprisingly, it is not even on this pie chart. And if we move on from the government money to the private foundations and their grants that we have on the next slide, the picture is not really going to be much better. As you can see, only 6% of the private money goes to the environmental causes. It makes perfect sense to do as much as we can to improve the situation. In fact, in Canada, we have one of the best charity supporting systems in the world. And when I'm talking about the system, I mean the Canada Revenue Agency. They intentionally give up their tax revenues to allow you to support your favorite charities. And that is why, talking about tax minimization today, minimization taxation of your estate, we do not try to avoid taxes. Instead, we're going to see how we can distribute our own money in a way that our families and our charities benefit most. Let's move on to the next slide and start our presentation. Today, we're talking about the taxation of the estate. And when it comes to it, there are two most dreaded words in the Income Tax Act that you must be aware of, and they are deemed disposition. In a simplistic way, it means that everything that the deceased owned is deemed to be sold at fair market value. And it doesn't really matter if it was actually sold or not. All gains and income from that deemed disposition are added to the final tax return, on top of the income the deceased person actually earned in that year. It could easily move the marginal tax rate of the estate above 50%. And just for your information, the top tax rate in Ontario is 53.53%. Today, we're going to review three most impactful examples that are commonly present in the estate. And they are RRSP types of accounts, family cottages, and any other secondary real estate properties, and regular or non-registered savings. We will also discuss a couple of more sophisticated and efficient donation strategies that help both your estate and your charity. With that in mind, let's move on to the registered accounts. And they are RRSP, RRIF, and various locked-in versions. All those accounts have two things in common. Every penny taken from this account is fully taxable. And when the account holder dies, those accounts are subject to a spousal rollover, which is in fact a great thing. When the first spouse dies, and if, and that's very important, the other spouse is listed as a beneficiary, the entire balance of the account is rolled over to the survived spouse without any tax implications, neither for the estate of the deceased nor for the survived spouse. However, when the last spouse dies, or a single person dies, or God forbid, a couple dies in an accident, the entire balance of RRIF or RRSP becomes taxable income, which may create a taxation bomb, because it is added to the income of the deceased in the year of death. If somebody had a modest income over the last few years of their life and had a sizable RRIF balance when they pass away, that entire balance will be considered a part of their annual income on top of any other income they might have legitimately received. And if somebody designates some of their children as RRIF beneficiaries, unfortunately, it does not solve the problem. In fact, it creates one. Yes, the beneficiary receives the money, but the estate will still be liable for taxes. And beneficiary might voluntarily pay the taxes, but might as well just walk away with the money. But the remaining part of the estate will be liable for those taxes, meaning that the remaining beneficiaries will be paying taxes for the one who walked away with the RRIF money. And that is why I included that bullet point on the slide. RRSP types of accounts are the worst to pass to your heirs. Try not to do that. Just use your RRSP money to support your lifestyle as much as you can. Don't save it for grandchildren or any other causes. Some people even do something called deregistering. They intentionally make higher than necessary RRSP or RRIF withdrawals and invest the unused difference in tax-free accounts or regular savings accounts. The idea is to pay a little bit more taxes every year, but avoid that 53% taxation bomb in your estate later. To make deregistering more efficient, one could use borrow to invest strategy. It works best for those who don't really need their RRIF payments, but forced by the government to take it after the age of 71. The idea is based on the fact that if you borrow money to invest, the interest on your loan or line of credit is tax deductible. You take a loan which interest matches the annual RRIF withdrawal and use this withdrawal to pay the interest. It eliminates RRIF withdrawal taxation and at the same time allows you to create a sizable non-registered investment portfolio, which is taxed much better, and fund it with the RRIF money. And now comes my last but surely not the least point about the RRSPs and RRIFs. These accounts are perfect for charitable donations. For example, if you designate any individual other than your spouse as a beneficiary of your leftover RRIF balance, they might receive less than a half of it, well, as a result of a taxation bomb that we discussed earlier. However, if you make your spouse a primary beneficiary and your charity as secondary or contingent beneficiary, when the time comes, the charity will receive the remaining balance and issue the corresponding tax receipt. There will be no loss for the charity, and there will be a taxable benefit for your estate. Of course, if you have no intention to make a donation, that's a different story. But if you do, designation the charity as a contingent beneficiary is one of the most tax-efficient options. Well, with that in mind, I would like to move on to our next slide, which is a family cottage. And families keep cottages for years, shared between parents, children, grandchildren, without really thinking who owns it. Cottages often have high sentimental value. And when one of the cottage owners dies, it is also subject to a spousal rollover, just like the RRIF. However, when the last owner of the cottage dies, the entire capital gain at that cottage accumulated over the decades of the family ownership becomes a part of a single-year tax return. And this situation could be even worse than the previous RRSP example. Why? Well, because cottage is not really a liquid money. If, in order to assume the ownership of the cottage, the children of the deceased have to pay $40,000 or $50,000 in taxes, well, they have to find the money somewhere else or be forced to sell the cottage. There are a few things that you can do about it. Most people know that you have to keep all receipts related to renovations that you made to the cottage. Those costs will decrease the capital gain and the taxes payable. However, it's very important that you keep receipts related to actual major renovations, not just day-by-day maintenance of the cottage. CRA is very particular about it. You could consider selling the cottage to your own children now to minimize the gain, because 10 or 20 years from now, cottage will become much more expensive. And you also might have a dedicated amount of life insurance to cover the cost and final tax return. And by the way, this solution works with pretty much every estate taxation bomb, not just the cottage. And right after this, I'll discuss one of the most efficient types of the life insurance policy specifically for the estate succession purposes. With that in mind, let's move on to the next slide about non-registered savings. And this term simply means that savings accounts or portfolios that you keep outside of your RRSP or tax-free savings account. And quite often people keep dedicated accounts or portfolios to transfer to their children or grandchildren. They could even name it as Mike's portfolio or Cindy's portfolio. They could use some of it to supplement their retirement, thinking that whatever is left will go to those grandchildren. And by all means, the taxation of non-registered account is much better than 100% taxable RRSP or RRIF. However, any capital gain that has been building in that portfolio over the years will end up on the final tax return, entirely allocated to a single year of death, on top of the income actually received, on top of the capital gain from the cottage and everything else. There are different ways around it. In the next few slides, Candice will thoroughly explain some efficient and sophisticated donation strategies that could help both your charity and your estate. But right now, I would like to show you one of my most favorite solutions for non-registered money, which is the universal life insurance policy. First of all, it is the most inexpensive type of permanent insurance. In fact, universal life is just a term to age 100 insurance policy that has the investment account attached to it. And the tax treatment of that account is so preferential that some people even call it a tax-free savings account on steroids. You may add money to it whenever you want at your own pace, monthly, quarterly, annually, or just once in a while. You can select the investments from a wide variety of options that every insurance company provides for you. It includes different investment funds, GICs, daily interest accounts, whatever your risk appetite might be. But any capital gain, dividends, or interest earned in that account remains completely tax-free. And when the person dies, the balance of the investment account is added to the actual death benefit and then given to the beneficiaries, again, tax-free. Hence comes the nickname, TFSA on steroids. By the way, you can make partial withdrawals from this account to supplement your retirement. Of course, those withdrawals will be taxable to some extent, but the taxation still will be much better than fully taxable RRSP or RRIF. Also, life insurance policy is a very tax-efficient way to donate. If you designate a charity as one of your beneficiaries, first, the life insurance policy generates a tax-free payout, no taxes to you or your estate. Second, the charity provides the estate with charitable receipt that helps offsetting tax liabilities that estate might have. For example, the capital gain on the cottage. It creates a double win situation. Your charity receives a sizable donation and your children inherit the cottage tax-free. And both tasks are accomplished with the same dollar. On this optimistic note, I would like to pass it over to Candice, who will tell you how you can enhance your charitable estate strategies even further.
Thank you, Vlad, and good afternoon, everyone. In Canada, the tax system is the most generous in supporting philanthropy in the Western world. The Canadian government has created effective rules and laws because they want to encourage Canadians to give. And in 2006, the Canadian government announced some donation guideline changes, which further incentivize Canadian taxpayers to donate by eliminating capital gains on donations of appreciated securities that are publicly traded. For example, your stocks or mutual funds in your non-registered account. This means that donating appreciated securities is a double benefit and that the donor will receive a tax credit based on the current market value of their donation, and they do not need to pay capital gains tax on the appreciated securities. In a survey to Canadians for their motivations to give, compassion towards those in need and personal beliefs in a cause topped the list. And on the contrary, giving to receive a tax credit was not a motivation at all and ended up last on the survey. However, it is interesting that tax credits have the highest effect on the amounts donated and have a large impact on donations. 85% of Canadians say that they give, but only 20% file their donation tax receipts. This means that most Canadians are not taking advantage of this tax benefit and really need to explore a planned giving strategy. On the next slide, we will take a look at an example of donating $30,000 of appreciated securities to, for example, the Wildlands League. If you have a corporation and you donate it from there, just remember that you will have an even greater enhancement of these donation strategies. So this is a double win when we're donating $30,000 of appreciated securities. On the right-hand side, the chart, it shows a capital gain of $20,000 on your $30,000 appreciated security with a $10,000 book value. half of this gain is taxable, leaving it a $10,000 amount to be taxable at, for example, the highest income tax rate, 53.53%. That means your income tax would be $5,353. But since you're donating this as an appreciated security, you don't have to pay any tax on the gain. A charitable tax receipt will be issued to you in the amount of around $12,000, and this is calculated based on a CRA calculator. And therefore, including your tax of the capital gains eliminated of $5,353, your total tax savings added together is $17,360. This after-tax benefit means that you have a huge amount of gains. So your total after-tax cost savings is $30,000 minus your total tax savings, which means it's $12,640. So as mentioned before, if you donate this way through a corporation, it's a greater enhancement of this donation strategy. And the last important point on this slide is that donating appreciated securities does not have an impact on your personal income figures. Donating appreciated securities is a known strategy that your financial advisor can help you with. And if they need any further guidance, they can feel free to reach out to myself or Vlad, and we can help further. Now let's move on to the next topic, leaving a legacy. If you want to leave a legacy and want to involve your family in the process, you should explore setting up a donor-advised fund or a private foundation. We will take a look at the differences of these two giving structures next, and which one would work better for you and your family. If you want to take advantage of donating your appreciated securities that we just talked about in the previous slide, but don't know where to allocate these donations yet, you can donate them into your own donor-advised fund or private foundation and decide on which charities you want to grant to later on. On the next slide, we will look at the similarities and differences between a donor-advised fund and a private foundation. So first of all, what is a donor-advised fund and a private foundation? Well, they are both ways that you can manage your personal or family charitable endowment. But why would you consider setting up a charitable endowment in the first place? If you want to consider creating a family legacy that lasts for many generations, or have control over how the money is invested and granted during your lifetime and after your lifetime, you should explore setting up a charitable endowment. A donor-advised fund is a personalized charitable giving vehicle administered by a public charity. For example, at CC&L Private Capital, one of the organizations we use is Canada Gives, or you can open one up at a local community foundation. These public charities are created to manage charitable donations and on behalf of organizations, families, or individuals, and they are tailored to the donor's philanthropic journey and objectives. You can even set it up so that your estate donates to your own donor-advised fund, and the estate will get the tax credits, and your next generation can maintain control over the donor-advised fund. To participate in a donor-advised fund, a donating individual or organization will need to open an account through a DAF administrator like Canada Gives. They simply transfer cash, securities, or other financial instruments into it. And usually setting up a DAF is a part of a strategy to take advantage of taxable events or to set it up in a tax-efficient manner like donating appreciated securities. You would surrender ownership of anything you donate or transfer into your donor-advised fund, but retain your advisory privileges over how the account is invested and how it distributes money to charities. A private foundation is similar to a donor-advised fund, but needs to be set up from scratch, from the registration of your private foundation by the CRA to the administration of the foundation. It offers the donor the greatest control, but also requires the greatest amount of time in running the foundation and attention on selecting the charities to receive grants from your endowment. Your successor will also need to be as enthusiastic as you to carry on the responsibilities of your private foundation. And we are definitely seeing trends of private foundations converting to a DAF structure for simplicity in the last few years. Once you decided to set up a charitable endowment, you can go two ways from there. You can set up a donor-advised fund or a private foundation. Now, let's take a look at the differences. The starting amount for a DAF is $10,000 to $1 million or even more, from even 5 million or 10 million because of its simplicity and cost effectiveness. For a private foundation, you wouldn't want to start unless you have a larger amount of at least 5 million plus to make sure that the fees make sense. You do need to pay for each of the fees individually. Your accounting fees, your legal fees, administration, investment management, and all of that at $1 million private foundation costs around $19,000. For a donor advised fund at $1 million, it would cost around $12,500. And this is a tiered fee structure, which usually starts around 1.25%. As mentioned before, the administration of a donor advised fund is very simple. It's completed through the donor advised fund provider. But the private foundation, it is your responsibility to hold regular meetings, to keep the minutes, to issue the tax receipts, to report to the CRA, and to administer your own grants. So for that reason, you're going to need to have a board of director, you need to have an AGM, and you need to do your corporate filings for a private foundation, but none of that is required for a donor advised fund. So it does become quite simple and flexible to have a donor advised fund. And with the private foundation, if you're willing to put in the work, it does need to be more hands-on, but can be very fulfilling as well. Donations into your donor advised fund and private foundation are exactly the same. You can donate cash, securities, insurance proceeds. You can even have an insurance policy through these different private foundations and donor advised funds. And donations can be made by anyone into your own donor advised fund or private foundation. And the last important point is that private foundations are anything but private. They are publicly listed on the CRA, and there are over 85,000 charities that will solicit you by going through the list through the CRA every year. So if you do truly want to be anonymous and private in your donations, you can do that through the donor advised fund and select that way of saying that you want to be an anonymous donor. So strategic philanthropy is much more than making a one-time donation to charities in a year. It's about incorporating tax strategies to help out and to empower you to support the causes you believe in. On the next slide, I will just summarize what we talked about. And Vlad had some really interesting points before. The key thing is that taxation is an important thing to consider in addition to the legal aspects of setting up your will. He went through different types of investment accounts that have different tax effects on the estate, the registered investment portfolios and some solutions to help out with that, what to do with your cottage and rental properties, and the non-registered investment portfolios, which I went over a few of the donation of appreciated securities as well. I particularly liked hearing about the life insurance strategies that allow you to donate more effectively, especially the TFSA on steroids. That sounds very interesting. And for anyone who does have some appreciated securities that they feel a little bit trapped on the capital gains of them, consider donating some of that to a charity that will give you that double taxation benefit. And you will definitely feel it when you do it. A lot of my clients tell me they don't even realize that they donated money because it doesn't feel like that large of an effect, but the taxation benefits are very big. And if you wanted to create your own family legacy, consider having it through a donor advised fund or a private foundation. And now I'll turn it back to Janet to jumpstart the question and answer period.
Thanks so much, Candice and Vlad. That was really interesting for me. As you're going through these each webinar at a time, I learn so much, and certainly learned quite a bit on this one. So I just we currently benefit. I think what's interesting for me is we currently benefit from a number of these strategies where people have taken the time and been thoughtful enough to make Wildlands League as one of their beneficiaries, whether it's DAFs or donations of insurance. And I think the life insurance strategies that you were discussing, it was very interesting to see it from the donor perspective and what your considerations are and how you might be putting that into work. So to that end, I have a few questions that I thought we might just further dive into this in a little bit. So my first question up is, what is the best way to set up my beneficiaries for registered accounts if, for example, I want to leave it to a spouse and Wildlands League? How would you go about doing that? How does that work?
Well, I think the best way of doing it is to set up two separate beneficiaries. And the first one definitely should be your spouse. However, secondary or contingent beneficiary should be the charity. That is a standard procedure. It should be allowed in every financial institution, but surprisingly, it is not. And it is specifically internal business of every financial institution. So some of them just don't have forms that allow secondary or contingent beneficiary. And if you are thinking about this, I would say just shop around. Don't get discouraged if your financial institution doesn't give you that opportunity. It's not the law. It is just them. There are plenty of respectable financial institutions that allow you to manage multiple beneficiaries, multiple primary beneficiaries, multiple secondary beneficiaries. It shouldn't stop you from doing it the right way.
So Vlad, if they don't have it on their form, is there any benefit in just saying to them, get me another form, or just like,
well,
can you push them to do it, or is it?
Just based on my personal experience, negotiation improves your chances in 80% of cases.
Okay.
Definitely ask for it.
Okay.
If it doesn't work anyway, well, there will be other people who will be happy to take your money and service you properly. Yes.
Yeah, shop around, provide that service. So when the owner of a locked-in account like Lyra dies and it rolls over to the survived spouse, does it stay locked?
Oh, that's a good question. No, it doesn't. It actually unlocks itself and becomes regular RRSP or RRIF account.
Ah, okay. Well, that's an interesting one too. So this is another one that I've heard asked by some of my friends. Can I open a joint account with my children so they will get the account when I die without paying tax? That seems like a thoughtful way to do it. Does it work?
Well, this question is much more complicated than it sounds. It has been a silver bullet for decades. People were opening joint accounts and they were rolled over to the children when they were passing away. Well, Revenue Canada started questioning these strategies. And they started treating those accounts as, say, proportionate shares.
I see.
That is why the best way to protect yourself from unnecessary trouble in this approach is to talk to a lawyer. Unfortunately, it goes outside of scope just financial planning. It's a legal issue now, and lawyers would be the best to know the latest CRA ideas on this topic.
Mm-hmm. That sounds like good advice. So, Candice, I think you mentioned, or maybe it was Vlad, that corporate donations can be more effective. How does that happen? What does that look like?
Well, I can take that.
Okay.
With corporation, you receive all the benefits that you receive with the personal donations. For example, if it's appreciated securities, yes, you do not pay capital gain, you get tax receipt. Or if it's a donation of life insurance policy, you donate it tax-free, you also get a tax receipt. But with corporations, you also get additional tax break that I really don't want to get into details, but on top of a regular double benefit that you receive otherwise as individual, you get ability to have extra tax-free dividends for shareholders, which are usually members of the deceased family.
I see. Okay. And you both spoke about trends, and so maybe you could just tell me a little bit, what are the impact investing trends?
Yeah, so for impact investing, everyone is trying to do good in the world, trying to invest in things that are doing good in the world. So these are areas that we're seeing a tremendous amount of uptick or questions or people being interested in allocating their money to. So beyond being charitable on your own front of choosing the causes that you want to support as being impactful as well, impact investing just means that in the types of investments that you want to be sort of growing your own net worth and making the right choices with, that those companies are also making good choices for the world and, for example, benefiting on the opposite side of climate change and really anything that would fit through different environmental, social, and governance factors on the positive side.
Yeah, I would say it's almost like a palpable hunger in society to do good, or to, as you say, do the opposite of where we had been tracking. That with COVID, it's maybe brought it into sharper focus, and certainly climate change and the global loss of species has really inspired people to say, okay, how can I make a difference? What can I do? And I think that that's where people are choosing their investments, but also choosing their gift and will and how they move forward, right? So we're seeing an uptick in that, and as I said, even for younger people who might not yet be at the stage where they're thinking about a gift and will, they're still thinking about how do I make choices that can make a difference. How long does it take to, I love these donor advised funds, and we've been the beneficiary of some of them, but also as a charity, but also just personally, I really like this idea. How long does it actually take to open one? And who can actually be the who can get money from a donor advised fund? How does that work?
So to open one up is a 2-page account opening process, very, very simple. It can be done the same day. Where the challenge could be is if you're donating appreciated securities into it, that could take maybe a few weeks. It really depends on the financial institution that's transferring it in. So really at this point of time of year when a lot of people are thinking about donations and structuring their taxes before year end, just to be very mindful of the time period it could take. Financial institutions have up to 30 business days allowable to make the transfers happen. And if you're doing it for tax reasons before December 31st, you just want to make sure you get it in before that and not after, because otherwise it's the day you get the tax receipt that matters. So the day the money hits your donor advised fund is the day you get the tax receipt. So that's the only part that could take a delay. If you're just putting cash straight into it, it's a simple electronic transfer, and that should be instant.
It's interesting. Can real estate be donated to a charity in a similar way to appreciated securities? How does that work?
So Vlad, I think you have some thoughts on that one.
Well, unfortunately, I have to say no. Real estate cannot be donated as appreciated securities, and I know that charities working with government a lot on creating the same rules, that capital gain on the real estate donated to charities, on the land specifically donated to charities, will be forfeited. But so far, unfortunately, we don't have it. We have this unique opportunity with appreciated security. That's where we can take advantage.
Yeah, we've definitely received that question before. We've had people phone us up and ask if they can make a donation, and that hasn't worked out, as you say. That doesn't work. So Jan, I'm not sure if you have any other questions in the chat box, but those are the lists that I wanted to go through and make sure that we got with our experts, because they know far more about this than I do. But I wanted to give a big thank you to both Vlad and Candice. I know we have 2 upcoming webinars that people can enjoy and we'll be able to check out on our website and register for. And if you haven't had the chance to view this, we will be posting in its entirety, or even want to look at it again, we'll be posting it up on our website and sending this around for folks. So thanks so much, Candice and Vlad. I really appreciate today's discussion. It's been hugely informative for me personally, and also gives me greater understanding as people are making these donations to Wildlands League, just what some of the intentions are behind them. So thanks so much.
Thank you very much for having us.